ServiceNow just reported earnings. The stock is up 6.5% in the after hours. There has to be a glitch or something wrong in the system for a company like ServiceNow or any SaaS stock to have a green day once in a while. I mean, it hasn't happened in a long time for those stocks. It's been absolutely brutal for ServiceNow, Adobe, Constellation Software, and any company that has exposure to software in general. The company beat on revenues, they beat on earnings per share, and they also raised guidance. So the company is clearly not dead. If you look at the quarterly revenues for the company, every quarter it has pretty much made a new high since 2015. And I would argue that AI is very good right now. We have some pretty amazing models. Like if AI wanted to disrupt ServiceNow, I think it would have already happened. And I'm not seeing it in the numbers yet. And I'm going to talk about this in today's video. Now, I did do a video on ServiceNow 5 months ago, and I put in this warning sign because, a lot of people were saying it was cheap at 120, and I told you guys my price was $83 per share, which was crazy back then, but it did get to about $83. Now, for the earnings report, it was really good. Their RPO, which is something that I pay attention to, you could say backlog or future revenues, it was up 22% year on year. It was a little bit weak quarter on quarter, but year over year, it was up 22%. That's really amazing for the company. Renewal rate, which is very important, is still very strong at about 98% renewal rate. The subscription revenue growth, which is also important, I mainly look at the non-GAAP constant currency. It's about 23% for this quarter, much stronger than the last 4 quarters. Even the comparable of last year, it was 22%. This one is 23%. I'm not seeing any signs of a company that's dying or a company that's actually getting disrupted. Now, there's a few things that I didn't like in the earnings report, and mainly we could look at the income statement. They did grow really well in revenues from 3.2 billion to about 3.9 billion, but the cost of revenues have grown a lot from about 724 million to $1.1 billion. So they grew revenues by about, you say, 700 million, and they grew their expenses or the cost of revenues about 400 million. This is a lot for a company or a capital-light software company like ServiceNow, which has led the company's gross profit margins to massively decelerate from about 76%. This quarter, it went to about 70%. This is very, very low for a company like ServiceNow. This could be due to a few things. I think some of it has to do with some of the acquisitions that they did recently, but still, if that continues, in my opinion, it's really not a good sign. It's not a good sign at all, especially if you look at the operating expenses, which have also grown a lot this quarter. It was from 2.1 billion. They took it to $2.6 billion, mainly increasing marketing by about 200 million and 200 million in research and development. That's about, 2.6 billion. And it led operating income to decline from $358 million to $162 million. So that's not really good in general. Some of it was due to, again, some one-time expenses. But still, if a company, you could say, can't really price their product much higher than the cost of sale, and if it can't really grow without spending a lot on marketing, that's some signs of disruption in general. But I'm not saying it with ServiceNow. Like 1 quarter is not enough, guys. If quarters, if it continues and it goes to 68, 55, 50% gross profit margins, then you could say, yeah, something wrong or something is happening. But so far, I'm not seeing anything major with ServiceNow. But what I really don't like about ServiceNow and most of the software stocks is the stock-based compensation. The company generated 298 million in net income. Their stock-based compensation is $658 million. This is absolutely crazy, guys. There's even crazier stocks like Zscaler or others. There is like 5 or 6x their net income. But 652 million in stock-based compensation, I mean, that's really a lot, guys. And the CEO promised that stock-based compensation would go down, but the exact opposite has happened, and stock-based compensation has gone up from about 494, 547 to a record 652 million. It was starting to stabilize, and I was starting to feel a little bit better. but the stock-based compensation here is absolutely massive for the company. So when you look at the company's metrics and you look like you say like, oh, the company is trading at about 22 PE, the stock is cheap. It's not really trading at 22 PE. If you adjust for stock-based compensation, it's trading at about 30, 34 times earnings. And this is because there's a massive difference between GAAP and non-GAAP earnings per share, again, due to stock-based compensation. So for 2026, the 22 PE is based on $4.12. But if you use the GAAP PE, which includes stock-based compensation and all of that, it's about $2 per share. So that's really a big difference, guys, between the two. And I just wanted to highlight that since I don't see it being talked about a lot in companies like ServiceNow. Again, ServiceNow is not alone. A lot of those software stocks have their own problems and their own stock-based compensation. There's very few exceptions like Constellation Software, which doesn't have stock-based compensation, but that's 2026, I guess. Now, in terms of my valuation model, I put in 17% growth for 2026, which is what's guided and what's expected. After that, I put in 20% from 2027 to 2030. This is what the analysts are expecting, 20%. I think 20% is highly achievable. The current trailing PE is about 28 times. I put in 28 times also for 2030. All in all, I get about $238 per share, 143% on the upside, or almost a 20% annual return from today's price. And this is not bad at all for me, as you could say, is a base to best case scenario. But whenever I buy stocks in the market, I try to buy them on the worst case scenario. And for me, the worst case scenario or the conservative case scenario is that ServiceNow trades at about 20 times earnings, and we have a multiple contraction that's permanent amongst the software stocks. Now, if that happens and ServiceNow trades at 20 times earnings, you would have to buy it for about $85 per share to get it double over the next 5 years. So I think ServiceNow here, is not bad. The company beat on earnings, great report, great CEO. He's very enthusiastic about the company. But in my opinion, today's price, you could say, is okay, is reasonable, but it doesn't present any kind of a generational buying opportunity or any major bargain for me. And I don't own ServiceNow. I own other software stocks, but if I had to buy ServiceNow, I wouldn't pay much more than $85, $90 per share. I think this is a sweet spot for the company, which is about 13% from here. It's really not a lot. But this is my valuation model on ServiceNow. Hope you enjoyed it. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.